Tonight, the question is not whether oil has moved. It has. The real question is whether this is a temporary spike or the beginning of a sustained global energy shock. Because history shows us something very clearly. Energy shocks do not stay in the energy sector. They spread to inflation, to interest rates, to stock markets, to currencies, to consumer confidence, and ultimately, to economic growth itself. Oil prices have risen sharply following the weekend escalation involving Iran. Crude has climbed roughly 7 to 8% in early trading, but this did not begin overnight. Prices had already risen from around $60 per barrel weeks ago to nearly $78 before the strike. Markets were pricing tension. This is important. Markets rarely react only to events. They react to probability. By the time conflict becomes visible, part of the risk premium is already embedded. The key term here is war risk premium. That premium reflects probability of supply disruption, insurance costs for shipping, maritime security risk, sanctions uncertainty, potential retaliation cycles. And right now, that premium is growing, but it has not yet exploded. The reason? Supply has not yet been physically disrupted. The real concern lies ahead. The center of market anxiety is the Strait of Hormuz. Approximately 15 to 20% of global oil supply passes through this narrow waterway. In addition, around 20% of global liquefied natural gas exports, particularly from Qatar, also transit through this corridor. If Hormuz is disrupted, even temporarily, supply shock becomes real, not theoretical. And in commodity markets, perception can become price before physical shortages even occur. The mechanism is simple. Shipping risk rises, insurance premiums surge, tanker availability tightens, delivery costs rise, futures spike, spot prices follow. And if drones, naval blockades, or missile threats make passage unsafe, traders will assume worst-case scenarios within hours. That is how oil can move from $80 to $120 very quickly. Analysts are already publishing aggressive forecasts. Some are projecting $100 per barrel. Others say $115. More extreme calls suggest $150. We have seen this before. When Russia invaded Ukraine, oil surged toward $120. But here's the key variable: duration. If disruption lasts days, markets stabilize. If disruption lasts weeks, prices accelerate. If disruption lasts months, we enter structural inflation territory. And structural inflation forces central banks into very difficult positions. Energy feeds into everything: transport, food, manufacturing, electricity generation, chemicals, fertilizers. Higher oil means higher input costs. Those costs pass through supply chains. Inflation expectations rise. Central banks, including the Federal Reserve and the Reserve Bank of Australia, then face a dilemma. Do they tighten policy again to control inflation, or tolerate higher inflation to avoid recession? This is the nightmare scenario policymakers hoped was behind us after 2022-2023. Energy-driven inflation is politically toxic and economically destabilizing, and it directly affects households through fuel prices, electricity bills, mortgage rates, which leads to reduced consumer spending, which slows GDP. Global equity markets are already fragile. Valuations, particularly in technology, remain elevated relative to long-term earnings growth. Companies like Microsoft and Atlassian have experienced valuation pressure in recent quarters. When markets are richly valued, they are sensitive to shocks. Energy spikes act as a tax on corporate margins. Higher fuel costs, higher logistics costs, higher wage pressures if inflation returns. Profit expectations adjust downward. Risk appetite shrinks. And leveraged financial players begin reducing exposure. This is how a geopolitical shock can trigger a broader financial correction. Not immediately, but progressively. Recent stress in financial institutions, including volatility among major banks like Goldman Sachs, shows that confidence is already delicate. In high valuation environments, markets do not need a catastrophe. They need a trigger. If energy prices spike sharply while corporate earnings weaken, margin compression accelerates. That combination can tip sentiment from optimism to risk-off. Capital rotates into gold, U.S. Treasuries, defensive sectors, energy producers, and away from high-growth tech, leveraged equities, emerging markets. Gold has already benefited. When geopolitical risk rises and inflation fears return, gold becomes attractive, not because it generates yield, but because it preserves value in uncertainty. For countries like Australia, which export both energy and gold, this creates a mixed dynamic. Higher export revenues improve trade balances, but domestic consumers face higher living costs. This is the paradox of commodity economies. Oil gets headlines. Liquefied natural gas is equally important. Asia depends heavily on LNG shipments from the Gulf. If those shipments are interrupted, energy prices in Japan, South Korea, and parts of Europe could spike again. Industrial production would feel immediate strain. Energy-intensive sectors, aluminum, steel, chemicals, would face margin compression, and electricity markets would tighten globally. Best case, tensions de-escalate quickly. Hormuz remains open. Oil stabilizes below $90. Markets digest the event and move on. Worst case, shipping disruptions occur. Oil breaches $120. Inflation expectations rise. Central banks tighten again. Equity markets correct 15 to 25%. Global growth slows sharply, most likely. Somewhere in between. Markets price risk dynamically. If no further escalation occurs within days, the premium may slowly fade. If escalation continues, volatility increases. Energy shocks are never isolated. They ripple through households, through markets, through policy, through geopolitics. The next few days are critical because oil is not just a commodity, it is a transmission mechanism. And when transmission mechanisms activate, the consequences extend far beyond the battlefield. We are watching not just a military story. We are watching a macroeconomic stress test, and the markets are already reacting.